So we have not heard back from the borrower yet on that deal to tell us if the seller is indeed going to agree to those terms. But I'll tell you this, if the seller agrees to those terms, that's going to be a very, very easy loan to fund. Okay, not sure who's asking this question. Would you loan on multiple homes, 6 or 7 single family, when part are finished and the remainder of homes are not completed? Great location. Banks want to sell bad. Okay. The way that you've positioned this question where you say that the bank wants to sell bad, what that tells me is that you don't actually own these properties. So the answer to your question is yes. However, because some of these are partially constructed, the most you're going to get on these things is about 50%, which means you're going to need to bring in a partner, other collateral, cash, something of value to put up in the form of 50 cents on the dollar. So I don't know what they're asking on these, but if they want, say, $300,000 for all 7 houses, the most anyone's going to be willing to lend on this is $150,000. Guys, let me make this point while I'm here. For those of you that are listening and watching from home, if you have cash that you want to lend, you gotta make sure you check this, because some of you might be getting a little emotional. Well, I can't believe you can't lend 100 cents on the dollar, and on and on and on and on and on. Here's the point. If this was your money, would you want me lending your money at 100% acquisition with no skin in the game from the borrower? No, you wouldn't. And if it was your money, you wouldn't lend it that way either. So guys, you need to really check this and qualify it. But Lee, what about no money down financing? Guys, if you get a $300,000 portfolio of 7 houses from a bank, and one of my affiliate partners puts up $150,000, and you bring in another partner to put up $150,000, that's still no money down, all right? You just need to think a little bit more creatively, think outside of the box a little bit here, because if it's a good enough deal, the money will be there. And I truly, truly believe that, and it's been proven every time. Okay, Brian says, as is value is not also the same as the purchase price. As is value is not the same as the purchase price. Should I ask for as is value when borrowing? No, Brian. You need to ask for the as is value or the purchase price, whichever is lower. Okay? So if the as is value is 80 and you're buying it for 100, my question is, why are you buying it for 100 if it's, as it sits, it's worth 80? Now, certainly forced appreciation through fix-up and repair, beautifying the property, making it more valuable through the forced appreciation, there's something to be said for that. But you're only going to get 65% of the 80 because that's your purchase price. Brian, can I get a company to lend money such as an LLC? Brian, you can take title in property however you want as long as the lender is willing to lend to the entity. But I'll tell you this, unless it's like this duplex deal here or this mobile home deal here where the lender's putting up 29 cents on the dollar, in a scenario like that, because the risk is so low, they could really care less. Put it in an LLC, put it in a corp, whatever you want to do. However, the closer you get to that 65% threshold, the more leery the investor is going to be to give you money. So at that point, if you want to title it in an LLC, they're probably going to require that you personally guarantee it. So what have you accomplished here? I know you want to title in an LLC to avoid liability, but if you're trying to borrow the maximum allowable on that deal, they're going to ask you to personally guarantee it, so the LLC really has become a moot point. Furthermore, if you're going to fund a deal through an LLC and your exit strategy is a refinance and a hold, you're now going to run into a problem with title seasoning, because if you're going to refinance it and you've purchased it in an LLC, whoever's going to give you the refinance or the takeout loan for the long-term carry through a conventional lender at, say, 6 or 7, they're going to require that title be in your name. So what happens is you'll have to quit claim deed the property from the LLC to yourself, close on the conventional financing in your name, because no bank is going to give you money in an LLC unless you've got a Dun & Bradstreet number. Then for asset protection reasons, you will then quit claim the property from yourself back to the LLC. Well, now you've clouded title and you've created a very ugly chain of title. So if your next plan is to sell that property, the new buyer coming to the table, if they're buying that house from you within 12 to 24 months, their lender is going to have a real issue with your title. So as you're going into these properties, you need to be really clear as to what your exit strategy is so that you don't get yourself in a position where you're making your exit strategy of a sale challenging. And man, I'll tell you, I have seen so many people make that mistake. All right, let's see what else we have here. Gwendolyn says this: are there any circumstances where you would consider tax assessed value? Absolutely not, Gwendolyn. Tax assessed value has zero bearing on value. And if you want the definition of tax assessed value, it is this. The tax assessed value of a piece of real estate is the maximum allowable price that the local municipality will charge you for without pissing off the seller or without pissing off the homeowner. How can I make such a bold statement? Well, it's simple. If you own a piece of property in an area of homes where value is $220,000 and your tax assessed value is $300,000, you better be challenging that assessment, because it's not hard to get the tax assessor's office to reduce the amount of your tax assessed value. And right now, this is especially true in California, they're actually trying to push tax assessed value because the state needs the revenue. The state of California is in a depressed state. They're really struggling. So they're trying to raise revenue wherever they can. So they're actually trying to push tax assessed value, which we know in California, values are already so deflated that the assessed values are much too high. And so it's a great question, Gwendolyn. I'm glad you asked it, because a lot of people do come to us and try to quote tax assessed value as a justification as to what's a good loan. And it just isn't. Okay? Great question, Gwendolyn. Okay, Barbara says, on 7 homes, single-family homes, would you lend on the entire project, part or finished? Barbara, you would need to have at least 35% participation in that loan, okay, in the form of equity, partners, collateral, whatever you got. Susan says, can you pay off the front-end points over a couple of years? Yeah, and Susan, I think what you're alluding to here was this example that Laura asked us about. And in this example here, if we were going to wrap in the points, if this was not a 90-day term, if this was, say, a 12 or 24-month term, and you didn't want to have to bring cash to the closing table, you could merely ask the lender to absorb the points into the principal balance and then amortize it over that 30-year period of time. And so, it'd be a 30-year am with a 12 or 24-month balloon. That's a very, very common and likely scenario, Susan. So yes. And guys, that's the other thing you need to know about hard money. It's one of the reasons I love it. Everything about it is negotiable. And if you don't like the points and the terms that we're quoting you, go find someone else. There's 1,000 lenders out there, and they all have different parameters, different comfort levels, different areas they like, places they don't like. I'll tell you, some of the more challenging places that we've had finding lenders that want to lend have been Michigan and Ohio. Why? Because those markets are incredibly depressed. I've heard stories, and these are not rumors, these have been proven. At the foreclosure auctions in Michigan, like Detroit, properties are actually selling for $1. At the tax auctions, properties are selling for $1. So it's a very depressed area, and it's really hard to get value. So investors are leery to lend there because their investment is questionable. And so that's why they avoid those places. I'm not saying all. We do have a few partners up there that will lend, but it's not their favorite by any stretch. Okay, Susan says, after closing in lieu of paying points with cash at closing. Okay, that's what we just got done addressing there, Susan. Okay, let's see. Who is this? Annie. All right. Annie says, would you consider a short refi to pay off the short payoff of an upside, whoops, what did I do? Mike, I made the PowerPoint disappear. Oh, okay, I got it back.
Never fear, Mike is here.
Thanks, Mike. All right, Annie says, would you consider a short refi to pay off the short payoff of an upside house at 60% and make a new note for 90 to 80% of the current value? If so, at what rates, fees? Some are already doing this to 90% after buying the note at a discount from the defaulted note holder. Annie, do me a favor. Rewrite your question in there and give me more specific details. There's a lot of details that are missing here, and rather than read between the lines, I'd rather, I mean, seriously, type out the whole scenario, because I think your question is going to be a fun one. But as it's been written here, there's a lot of holes in the question. So fill those in, and we'll come back to it. Gwendolyn, can you pre-approve financing for members of your hard money training program? Gwendolyn, the answer is maybe, okay? Maybe. Here's the qualifier. You've got to have the property under contract, all right? And we have people come to us all the time and say, hey, will you provide a proof of funds letter for us? Do you have it under contract? If you've got it under contract, yes, we can get you that. If it's not under contract, no. Well, then we get this. Well, Lee, if I don't have the proof of funds, then they're not going to look at my offer. Well, you need to negotiate differently, all right? Say proof of funds will be there. If you agree to the price, I can have proof of funds within 48 hours and move through the objection. I'm going to talk to you at the end of the day about some closing techniques and strategies that you can circumvent all of these ridiculous requests that these lenders have. Bill, if I'm lending other people's money, won't they charge me points? And how do I charge that off to my borrower and make a spread? If I'm lending other people's money, won't they charge me points? Bill, if you're lending other lenders money, then yeah, they're probably going to charge you points because they get it. And this game is not so much profitable from brokering to broker to broker. In fact, a lot of companies out there specifically prohibit broker to broker to broker relationships. So Bill, if you want to maximize your time and your return on your time investment, go out in search of people that have cash. Okay? Now somebody's going to ask me the question, well, isn't that in violation of SEC regs? Again, that's a legal question. Consult with your counsel. Here's my opinion. If they are a friend or a family member or someone that you already know in your sphere of influence or your circle, then you can talk openly to them about them. What the SEC says about raising money, and again, this is my opinion. I'm not an attorney or a financial advisor. I'm merely expressing my opinion here. If you're soliciting, marketing for homeowners that have cash that you do not know, that you do not have an existing relationship with, you have to determine that they are indeed an accredited investor, meaning they have a net worth of greater than $1 million and they can prove an income of more than $250,000 annually, subject to change. You now are in violation of SEC regs, in my opinion. Okay, again, I'm not an attorney, that's just my opinion. So Bill, if you want to maximize how you make money in this business, you need to go out in search of folks that have home equity lines of credit against property, investment properties, and they're earning 3 or 4% in their money market or their hedge fund or their 401k or their self-directed IRA, all right? And there are thousands, I'd go so far as to say millions of people who have money sitting in those investment vehicles and they're just not earning very much at all. And if you come to them and show them how safe these investments are, not risk-free, but safe, low risk, high yield, you'll be amazed how interested people will be to talk with you, okay? Okay, Quentin, Lee, would you do a church refi to purchase a single-family house that's going to be rented out? And who do you want to guarantee? The church is valued at $450K with a first of $90K. The single-family house is $75,000 to purchase. Would you do a church refi? Okay, so the church wants to refinance the church to purchase a single-family house that they're going to rent out for cash flow. The church is valued at $450 with a first of $90, and the single-family house is valued at $75. Okay. Oh, you know what I did, Mike? Nope, there it is. Okay, good. Got it. All right, let's look at this deal here real quick, Quentin. So you've got the church. Let me get my questions back up here. Okay, so you've got a church valued at $450,000. whoops. Okay, you got a church valued at $450,000 with an underlying lien against it for $90,000, and they want to borrow $75,000 to purchase this other property. I'm curious, Quentin, what the value of the other property is, but it's not important at this moment. 450. Now let's do this. 90,000 plus 75,000 equals 165. 165 divided by the value of the church is 450, which is a 37% loan to value. Okay. Now I'll tell you, we just recently were working with a church that they were actually acquiring the building, and they were buying the property for $150,000, and the church was putting down $110,000 of cash, which meant the church only needed to borrow $40,000 to get this loan. So we went out to some of our affiliate partners, and Quentin, I'll tell you the feedback we got. Here were the requirements for the church lenders that we were dealing with. They were looking for a congregation of larger than 900 people with monthly tithing in excess of $100,000 a month. And they said if that wasn't the criteria, then they couldn't lend. And I thought that was pretty steep. Now, we were able to get that loan pushed through a local credit union because it was a very, very low risk, low yield loan. So we were able to get that deal done. And Quentin, based on the loan to value here, I don't know what the congregation size is of the church or what the monthly tithe receivables look like. But based on just the numbers, I mean, if we could cross-collateralize the church and the house, I believe that that would be a very doable loan. Okay? All right. Guys, I have got to move on here, so I'm going to take the last question. Okay, here's Annie. Okay. Hey, Cliff, I got your text here, your message. Cliff says, I have great church financing. Call me. Cliff, I'm not going to broadcast your number here. But if you would like, send me an email to lee@imthesolution.com, and I will put you in touch with Quentin. You guys can connect. Okay? Okay, Annie says, then write a new note to the owner of a property at, say, 90% of the market value for up to 4 to 7% interest rate for 30 years as more investors are running into losing their upside-down properties since only owner-occupied. Homes are getting help with such situation. No change of title, only change of note holders from old lender to new note investor if possible. What fees and cost is fair? Wow. Okay, Annie, you got to shoot me an email on this one, okay? lee@imthesolution.com, because the way this is coming through in my little window here, it's just, I can't even make out all of the deals or the things associated with this loan. Okay, we got to move on here, guys. I'm running out of time. So let's move on in our PowerPoint presentation. So curious to see how you guys did with your question and answers. Hopefully you got all the same answers that I did. And if not, check out why you didn't and go back through them. All right, quick disclaimer. We've been going an hour and I'm just now getting the disclaimers. One, I make no claims on earnings, okay? You can lose a lot of money doing this business and you can make a lot of money doing this business. You just need to make sure that you do it right. Secondly, you can work with anyone you want to, not just me or my company or my affiliate partners. As I mentioned, there are thousands of lenders across the country. We just heard from another guy, hey, I've got great church financing. I don't know who his church back-end financing is. Maybe we have the same person, maybe we don't. Either way, you can see, just in this little presentation, we're already getting people raising their hands saying, hey, I do this type of funding, I do these types of loans. There's typically multiple people who specialize in a specific niche, whether it be church loans or commercial or residential refis, or I know of a group out of Atlanta, Georgia, and they specialize in a government program for buying your professional building if you're an accountant, a lawyer, a CPA, or something like that. Third, I am not a lawyer, and I cannot and will not give you legal advice. However, I am really challenged in not sharing my opinion with you because I want to make sure you at least know my position on it. And finally, we assume no responsibility for what you do or do not do. Please make sure, however, that whatever you're going to do, you go out and get legal counsel and that you have somebody review your documentation. And if you're going to cross-collateralize properties and do blanket mortgages and you're going to take in things like bill of sales and titles on other assets, other collateral, make sure that you have legal counsel draft that for you, and do not attempt to do it yourself unless you are an attorney. Okay? So let's get into the part where I'm sure all of you are most interested, which is how do you make money lending? Okay? So, how do you make money lending? Now, this corresponds with, in your book, guys, you all received a book in your email, and it looks like this, okay? So I printed my book out, and then I have put it in a 3-ring binder. So you all received it in your email. If you don't have that in your email, if you've never seen this book, it's actually about 115 pages. We're going to be using it a lot today. If you did not receive that book, my assistant is waiting in the wings. If you are watching this at home after today's live presentation, you will have received this book in the mail. It's in the hard copy form. So go ahead and get it, pull it out. Looks like this, okay? All right, if you are watching now and don't have this book, shoot an email to lee@imthesolution.com, lee@imthesolution.com. My assistant is sitting at that email address so she can answer your questions very quickly on that. Okay, so where are we at? All right, we've already done a lot of math today, so I'm just going to do one math problem here so you all can follow along. What does the borrower want? Now, in this scenario, and pay no attention to the PowerPoint on your screen, I'm just going to skip ahead to, here it is. Let's get to this PowerPoint. Okay, here is the scenario we're looking at on our book. So follow along with me. Mike, do you have a pen that's not a Sharpie? Okay, guys, so first thing we need to do is calculate 5 points. Thanks. 5 points at $345,000. So we're going to take $340,000 at 5 points, which is $17,250. $17,250, okay? So the total that's being borrowed now at this point, assuming that they're not going to bring the cash for the points to the closing table, we're at $17,250 plus $345,000. We are at $362,250, which is the total, all right? Now the term on this deal, let's see. June wants to borrow $345,000 for 3 months to repair her house that she will then refinance. How much would you earn on a hard money loan with 5 points and 19% interest? 3 months. Okay, so the term here is going to be 90 days. Now we need to calculate the monthly interest charge, which is going to be 19 divided by 12. So that is the monthly interest charge. It's 1.58%. The term interest charge is going to be 19 divided by 4, which is 4.75%. So the total term income. So to get that, we're going to take 362,250 times the term interest. So we're looking for term income. And our term interest charge was 4.75. And the way that we got that is, notice, guys, it's a 90-day loan. 90 days happens 3 times within the calendar year. So take 19 divided by 4 gives us 4.75. And I know that's a different way of getting there than you might be used to, but it's effective. Okay? So the term income on this loan is $17,206.87. The total term yield on this is going to be work like this. To get these, we take total term yield. We have to add together the total term income and the points. Okay, we got to add these two together. Shift the book up. Okay. Can you see it now? How's that? Okay. Okay. So guys, we're going to take 17,000. You can't see my calculator now. How's that? 17,250 plus the 17,206.87 gives us 34,000 total annual income. It's $34,456.87. Okay. Now the total term yield is received by taking that balance of 34,456.87 and dividing it by the amount that we lent, which was $345,000, which means we earned 10% on the term. Okay, 10%. So we added this together with this, divided it by the amount that we lent, and we earned 10% over that 90-day period of time. So to get your total annual interest or your total annual yield down here at the bottom, you're going to take 10 times the number of times you can lend it, which is 4, because there's 4 90-day periods in a year, which means you get a 40% return on your investment. So that's your annualized yield here. Your total annual income would merely be these two items, which is 34,446 times 4. Okay? So if you want your total annual income, we're going to take 34,456.87 times 4. We've made $137,827.48 over a year with a $345,000 outlay of cash. And that's how we got the 40%. Okay? So, if you guys are struggling with these, I got to tell you, this setting makes it challenging because I can't see anybody's faces. And when I teach this live, I inevitably get this weird deer in the headlights look. Here's the good news. It's important for you to understand why this happens, but if you're struggling to get the calculations accurate, it's going to come over time. And as much as I'd love to spend the next 3 hours on this particular calculation, we just don't have the time. The good news, however, is this. Guys, before you do anything in this business as far as lending or borrowing, please, 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 please call me. Consult with me. Even if you're not going to borrow money from me or one of my affiliate partners, at least please call me and get my opinion on the deal that you're about to go into. Certainly seek legal counsel, but I would encourage you, get my opinion to make sure that you're doing okay. Do I need to stop, Mike?
No.
Okay.
I'm changing tape on the little one.
Oh, okay. All right, some things to remember here. No principal payments are made until the end of the loan, which increases the risk. Interest is always compounded annually, so yield must be calculated over 12 months. No one uses simple interest except in judgments. 3, interest must compound daily, not weekly, monthly, etc., using a 360-year calendar. Okay, so interest is always compounded annually, so the yield must be calculated over 12 months. However, in 3, you can actually compound the interest by the minute, by the second, by the hour, by the day, by the week, by the month, by the year. Okay, what we typically do is we compound interest daily. So if you want to increase or maximize your annualized yield, compound daily. Now, traditional bank loans, they compound monthly. All right. But if it's your money and the borrower, in full disclosure, agrees to it, you can do it however you want, as long as you're not in violation of any state, local, or regulatory laws. Now, one more point I want to make, and I should have made this before we went on. On page 12 in your booklet, the scenario with June, even though this looks like a great high-yielding loan, it's not actually a loan we can make. And here's why. It says that June wants to borrow $345,000 for 3 months to repair her house. Her house. It does not say her investment property. It says her house. And guys, we cannot, will not, refuse to lend on owner-occupied single-family homes or anything where the owner is going to be occupying that property. That loan scenario is riddled with all kinds of red tape and government regulations, and we just don't want to get involved in it. Okay? So it must be a non-owner occupied investment property, or we will not touch it. Okay? We will not touch it. Okay, so we all need to make some money now. You kind of understand the way things work. We now need to start working on preparing a hard money bank. So if you're following along, I'm on page 14. Follow along on page 14. I've bulleted page 14 in the PowerPoint for you that you're looking at there. A hard money lender is a broker. You don't have to have any money to do hard money lending. You don't have to have good credit. You don't have to have a job. You just need to know how to do it. This starts with establishing your hard money bank. Now, your hard money bank is not a physical place. Rather, it is all of your sources for available money to lend. And that's what we talked about earlier. Who do you know that's got cash sitting in investments that are earning 2 or 3%? Okay? They are a good source for available money. You got to think of hard money lending as being a middleman, especially if you don't have money. If you have money, then you don't have to be the middleman. You are the man or woman for that instance. Middleman, you identify a source of money and you bring it to an interested market. And that's why when you guys got involved in this program, I taught you the concept of running that ad in Craigslist, investor has money to lend on good real estate. The whole reason for running that ad is to find a borrower that's got a good investment opportunity that you know other investors would be interested in putting their money into it. Now guys, I do it both ways. I invest my own money if I feel the deal is good, or if I have the cash available at that time. If I don't and still feel the deal is good, I'll bring in one of my joint venture partners to get involved in that transaction. I'll bring in a family member, a friend, whoever, and I'll say, hey, I've got a deal here that you're going to yield 15% interest. Why don't we put your money into it? And inevitably the question I always get is, Lee, would you put your money into this deal? And if I can't answer that with a straight, open, honest yes, then I'm not going to lend anyone else's money on that deal either. And that's where you guys really need to check yourselves at the door. If you wouldn't write a check on this deal, no one else will. So please, 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 when you're looking at these deals and you're contemplating submitting them to my office or anyone's office for that matter, and you know with a shadow of doubt that you personally would not write a check out of your bank account to fund that deal, I'm not going to fund it either, okay? So we need to work together as a team here to make sure that the deals you're bringing in are good investment opportunities. And I'm going to show you what a great deal looks like, and I'm going to show you what a wasted time deal looks like as we get into the late morning and afternoon sessions. So be prepared for that. Think of your hard money bank as a grocery store, all right? The store sells groceries, you sell money. You want customers to be loyal and depend on you, not shop you. So just like a store can never run out of groceries, you can never run out of money. Now, the reason I use the grocery store scenario is because I used to work at a grocery store. As many of you know, I was a grocery store bag boy, and I ascended up the ranks and I became a cashier. Well, from cashier I went to stock boy, so my job was to go to the back room and get stuff and put it on the shelves. Well, there were several instances where we had run out of product. We had sales, I remember this one vividly. We had a big sale on Clorox bleach, gallon jugs of all things, and we ran out. Well, I called our warehouse and they were out of Clorox bleach too. Well, now I got an issue. I've got customers that are looking to me saying, hey, I came here for the coupon for the Clorox bleach. Well, what I did is I ran across the street to Albertsons and I bought all of their Clorox bleach. Now, I bought it, brought it back to my store so that I could deliver it to my customers. Now, hard money is no different, okay? You have to have an endless supply of it. Again, does not mean it needs to be your money. You just need to identify funding sources. Just this week, we got ourselves identified with 25 additional lenders nationwide just this week, and actually in the last couple of days, 25 new lenders that like what we do, came on board, gave us commitments that we would have access to their funds if we got a deal that met their criteria. 25 new ones in just 2 days, okay? And we continue to grow that day after day after day, as should you, okay? In the grocery store scenario, if I'm going to run a big ad on Clorox bleach, I probably should have identified that my warehouse had enough Clorox, or I should have identified, or in addition to, I should have identified another warehouse, or 2 warehouses, or 3 warehouses that had Clorox bleach, okay? That way I can ensure that I would never run out of Clorox, and in this scenario, I would never run out of money. Now, the other reason that I use the grocery store scenario in this example is if you're a grocery store on the left side of the street, competing with a grocery store on the right side of the street, your prices have to be pretty comparable, meaning you can't be charging $10 for a loaf of bread if the guy across the street is charging $2, because nobody's going to buy your bread. And so guys, you've got to look at money in terms of business. Even though it's lending money for acquisitions, it's real a business. We have inventory. We have employees. The people that go out and do appraisals have to be paid. The place that we lend out of, we've got to keep the lights on. If you're going to have an assistant, you've got to pay them, which means you're going to have overhead. If you're going to run this like a business, you're going to have overhead. If you don't want the overhead, my recommendation, run it like a broker. You just identify people who need some cash, you turn it over to the people who have the cash, assuming that they can do all of that due diligence on the deal that's necessary. Just turn it over to them, and you can just make finder's fees and those types of things. But if you want to run this like a business, you're going to have overhead, you're going to have inventory. Now, in the hard money world, inventory can literally eat your lunch. And what I mean by that is, if you go out and borrow $1 million from someone, and you commit to them that you'll pay them 12% simple interest, which is effectively $10,000 a month, okay? If you don't get that $1 million placed, you're still spending $10,000 a month. So you've got to sell your money, which means you've got to properly market your business. You have to have a backlog of people who need cash, because you're much better to have more deals than you can fund than you are to have more cash than you can fund. So be very aware, this is a business and you need to treat it like one. You also have to think of money in forms of interest rather than in the form of tangible products. And I cite this example because a lot of people think of money in terms of consumables, meaning if I've got $1, I can go buy a sandwich. Okay? I can go get a 99-cent sandwich somewhere for $1. So most consumers think of money in the form of a consumable. What can I buy with this dollar that I can now go consume something? In the hard money business, you need to think of this like an investor, meaning for every dollar that I have in my pocket, it represents a 36% return on investment. So if I can take this dollar here, this dollar to me, invested the right way, represents a 36% return on investment. So for every one of these things that I've got, I'm going to make 36 cents. And as long as I continue to put that dollar into circulation, into deal after deal after deal, and I can get an annualized return on this dollar, what I'm now going to do, if I want to buy a sandwich for 99 cents, I'm going to get $3. I'm going to invest it the way I'm teaching you, and I'm going to take my return on investment, and I'm going to go out and now buy that consumable. Which is to say, guys, you cannot be spending your inventory. Your inventory is your cash. You cannot be spending your cash on consumables. You've got to be investing your inventory. The dollars you have sitting in the bank, you've got to be investing them into something. And the money you yield from those investments is now what you buy your consumables with. I see it especially in new beginners. If you're new to money, and I see this with a lot of people, they grasp these concepts, they get really excited, they go out and they start lending. Well, before they even get a return on and of their investment, they're out buying new cars and all kinds of things. Well, the issue is, if you know how to do this properly, every dollar you spend that wasn't lent out first, you just lost a 36% return on investment opportunity because you no longer have the inventory. Now, going back to the grocery store, if you walk into a grocery store and there is nothing on the shelves, that grocery store can't get a return on their inventory, which is why they always have their shelves stocked. But they also understand that you've got to turn that inventory, otherwise stuff's going to spoil. The financing on your inventory is going to end up costing you more money than you're making, and it really, truly is a business. And I'm not trying to scare anybody. If you've never run an organization in this manner, this is probably pretty foreign to you. And that's why if that's you, if you're the stay-at-home mom or the stay-at-home dad, or you're just looking for a secondary passive income, let me encourage you to just broker, okay? Just broker. Don't go out and raise private money and make representations that you can help people make returns. Just broker, okay? Find people like me that have access to the funds and have the infrastructure to run those monies, and just let us do it, okay? That would be safer. But I would set a goal for yourself to move towards achieving that, all right? And that goes on to here at the bottom. Think of money as inventory. The more you have sitting around, the more it costs you. You can't just leave it sitting around. It's worthless unless it's sold. You need to sell the cash you have in your hard money bank. Selling money is lending it. Don't have more inventory than your market is ready to use. Establish a marketplace before you create the inventory. So guys, if you don't have any loans in your pipeline, if you don't have anybody that's coming to you looking for money, then don't go out in search of money. Because if you bring that money in and you agree to pay interest on those funds, but you haven't lent it out yet, your inventory is going to eat your lunch. It's going to eat you alive. You've got to get it out. Hard money must be quickly available. Liquid, meaning it can be wired in 72 hours. So if you're just going to broker, make sure you're brokering through entities that can close quickly. Now, we're going to qualify that later because my company can close incredibly fast as long as the package is delivered to us in a completed format. And many people are just they're filling out the online form. They're not delivering us financial statements from the borrower. We're not getting appraisals. We're not getting valuation. We're not getting line item breakdowns on fix-up and repair. It's just an incomplete package. So if you want funding to be readily available in a liquid form, you've got to create the opportunity for that money to chase. You can't just be pitching what we call pitching wood, which is just slinging mud on the wall, filling out applications, and hoping that someone will want to do all the due diligence work on your deal. That's your job. You've got to do all the due diligence on the deal because, guys, you don't just call up hard money lenders and say, hey, I've got this house. Will you lend on it? That's not how you get financing. The way you get funding is you identify the property. You put it under contract. You build a good financial package around that opportunity, and then you take it to investors and you offer it to them on a silver platter. That's how you get funding on deals. What a lot of you guys have been doing, no. Okay? It's got to be delivered on a silver platter so that if my group doesn't want to fund it for whatever reason, you can take it to 25 other groups and see if they'd be interested in doing that deal with you. All right, hard money projects typically don't qualify for conventional financing. That's why people will pay the higher points and fees. The funding must be fast because good deals aren't just sitting around waiting for you. The faster you can close, the more you can charge. So you must have procedures in place for quickly doing due diligence to establish risk and for quickly preparing docs. Finally, don't borrow money that requires immediate payments. Don't borrow money that requires immediate payments. Meaning, I know many of you out there listening and watching at home, you might have home equity lines of credit, which I think is a good way to go, but also some things you need to be aware of. Home equity lines of credits are great because you only pay interest on them as you draw down against them. So if you have a $400,000 line of credit against an investment property or personal residence or something like that, you're only going to pay interest when you draw down on the money. Okay? However, some home equity lines of credit will charge you a stocking or a warehousing fee for your money, which means if you don't put it out there, you're going to get dinged a fee for it. All right? So be aware of that, but know that the ding of the fee typically is less than the cost of withdrawing the minimum requirement that they're asking for. I have a client right now She's coming to a point where if she doesn't use the money, they're going to charge her $800. So she would need to draw down $200,000 of her available line, which would cost her like $2,200. So the $800 fee is cheaper than the $2,200 that she would pay to draw out the money. But the point is, don't borrow money that requires you to make immediate payments, meaning don't do a cash out refinance on your house where you're going to incur a monthly payment. Paige, I would not lend on that deal because it's not secured by real estate, and companies can just poof, be gone overnight. So if it's not backed by real estate, I'm not interested, okay? Just be aware of that. All right, so again, we were talking about not borrowing money that requires immediate payments. Wait until you are ready to make the loan. Start by just arranging sources of money. You don't have all the facts yet, and you don't have a market yet. Wait until you're ready. Now, I'm talking to those of you that are new at this. Those of you that already have established lines of credit, you've already identified funding sources, and you're ready to lend, great. Now we just need to talk about building your package and putting it together. Now, remember what I said, that you always want to make sure you've got plenty of money. So let's talk about some sources of money, where we can go to get some extra cash. Well, the nice part about cash on hand is that it's immediately liquid. The downside of cash on hand is that if it's sitting in a bank account somewhere and you're waiting 30, 60, 90 days to find an investment vehicle to put it into, you're earning the bank rate at what? Quarter percent return on your money. After inflation, you're effectively losing 3% annually. So the downside of cash on hand is that you're losing money on it, okay? But it is immediately liquid. Home equity lines of credit. This makes the equity in your personal home or other owned real estate and your portfolio liquid. But what you need to do is to qualify with your home equity loan provider to determine how quickly you can access the line. Now, I told you there's something you need to be cautious of in a home equity line of credit. If you read the fine print of the loan documents that you sign on a home equity line of credit, you need to be aware that they can pull the line at any time. Home equity lines work very much like a credit card, and if you've ever read the fine print of a credit card statement, which you should, what you will see there is it is at the right of the lender to pull the line, reduce the line, eliminate the line whenever they choose to or whenever they see fit. Now, I've got a lot of friends that are contractors and they build houses and they do development and those types of things. Well, in 07 and 08, when the real estate market was just tanking, many of them had American Express cards. And they were calling me saying, hey Lee, why is American Express reducing my lines? They had a $100,000 line of credit, and then American Express drops their line to $50,000, $25,000. And guys, if you're using credit cards to substantiate or support your business for your monthly cash flows and payrolls, and they reduce those lines, I saw it happen to several close friends. Home equity lines are no different. So if you've got, say, a $400,000 line of credit, two things you need to be aware of. One, how quickly can you get it liquid? Two, what is the established procedure for eliminating your line? What has to happen, or what events need to transpire that they can legally pull your line? And be aware of those things. Because I've had people that I've seen them at foreclosure auction, and they used to buy a bunch of property, and then one day they weren't buying, and I went to them and I said, hey, you haven't bought anything in like 90 days. What happened? The bank pulled my line of credit. And it does happen. So be aware of it, and just be educated going in so you know how that works. Margin loans, borrowing money on your stock portfolio, not selling your position. This is liquid, and much like a hard money loan that charges points, interest, and fees, this is a way to make your stock portfolio liquid. I was out doing some consulting work with a client over in San Marcos, California not too long ago. And he was asking me the question, Lee, where can I get sources of money? And so we sat down, and I spent about an hour just kind of going through his financial portfolio and his situation. And come to find out that he had about $380,000 in stocks. And I said, well, what are you doing with your stocks? I said, why don't you get a margin loan on your stocks? And he said, what do you mean, margin loan? Guys, if you've got a stock portfolio, there are lenders out there that will leverage your portfolio, your stock portfolio, just like there are lenders out there that will leverage your real estate portfolio. So if you got stocks or you know someone who has stocks, the great part about a margin loan is you don't have to sell your position. You don't have to get rid of your stock, especially if it's climbing. You can just borrow against it. A typical margin loan, they'll give you 50% or up to 50% of the equitable liquidity value of your stocks, which means many stocks come with a retail value and a borrowing value. Typically, the borrowing value is certainly less than the sell value because they're hedging some risk there by reducing the valuation overall. So what I have seen in most of my clients who get margin loans is that they can borrow up to 50% of the margin value. Okay? Angel money or partners. This is money borrowed from private, silent sources that you lend for substantially more. The wrong approach is quoting what you're willing to pay because they can't comprehend it could be so high. Instead, ask, how much would you charge me to borrow it? Remember, the first person to quote a number loses. The amount they quote you is the threshold they think is possible. So what is an angel investor? It's not somebody flapping around walking through town with wings on, okay? An angel investor is nothing more than someone who has cash that's willing to put it up into your investment opportunity. Remember, cash follows opportunity. And if you've got a good deal and another investor wants to put money into that deal, they now are an angel investor. Angel investor also suggests that rather than taking a percentage ownership in the partnership that's buying the property or the entity that's buying the property, they're just going to take a return on their money. So here at the bottom, I've given you this little tidbit. Do not tell people how much you're willing to pay them, all right? In negotiations, the first person to name a number loses. So when you're out there negotiating to borrow money from people, don't tell them what you'll pay. And I've been saying openly, hey, I'll give you 12%. If that were a real scenario, I would never tell people what I'm going to pay them. I would identify how much they've got. I would ask them how much they need to get, how much they want to yield on their investment to make it worth their time, and then we would negotiate from there. Because if somebody is making 3 in their money market and 8 would be a good deal to them, that's a 5-point increase off of what they were earning. It's almost a 200% increase off of what they're earning. So if they're happy at 8, why in the world would you offer them 10 or 11 or 12? So when you're out there finding these funding sources, let them decide how much they want to get paid. Don't quote rates to anybody, okay? Credit cards, a great source of angel money. You can increase your credit lines to achieve the lowest possible blended rate, then lend it all at a higher rate or a spread. Most people would make more money getting more lines of credit and lending it as hard money than they would working a full-time job. Caution, be sure you can pay the monthly payments on credit cards while you wait for the borrower to pay you, or said another way, don't write loans that don't require monthly payments. Okay? If you're lending money that requires you to put out money each and every month to pay for the money you're borrowing, then don't lend it out where it's building against the principal payoff. Lend it out and require monthly payments of the interest. Okay? That's a much safer, much more lucrative loan if you've got to be making payments out. All right? Now, credit cards, interestingly enough, used to be a much, much better source for funding. Right now, not so much, but I believe that that's going to come back around. You guys need to understand that credit card companies draw down on bank lines of credit. And as many of you know, banks are having some issues in lending right now because they're short on cash. Well, when banks are short on cash, they immediately reduce the amount of capital outlay that they've committed to in the form of credit card lines, home equity lines, and they reduce those lines so that their commitment of outflow isn't as great, all right? So know that credit cards, not so much now, but in the future, there's a very simple strategy that we use for calling the credit card companies and getting them to not only increase our available lines of credit, but to also decrease our interest rates. Now, if you are a homeowner, you've been in your house 3, 4, 5 plus years, you've been at your job for 4, 5, 6 plus years, and you've got a credit rating 750 or higher, if that's you right now, I would encourage you, when we go to the lunch break here, to contact your credit card companies. And it's actually really quite simple. You just call the number on the back of the card here. You just call the 800 number, 800-232, call them up. Someone's going to answer and just say, hey, I would like you to increase my credit line and decrease my interest rate. And they're going to say, why would we want to do that? Well, if you give me more money to spend and I spend it, then I have to pay you more interest. So giving me more cash means you make more money. And if they won't increase it, then through that strategy, you just ask to speak to their manager, and then their manager, and then their manager. And you just move up the chain until someone gives you what you want. I had a client in Florida do that. She increased her lines of credit. This was at a live training I was teaching. She increased her lines of credit over the lunch break. She had 3 credit cards. She got her lines increased $100,000 in just a 1-hour period of time simply by calling up and asking. Okay, so there is value in that. Now, the reason I quoted the been in your house 5 years, been at your job 5 years, and a credit score 750 or higher is that's really the demographic makeup of the people who can borrow money in today's economy. Now, as we move forward, as money becomes more free-flowing again, as consumers start spending again, as the GDP increases, you will see banks loosening their belts a little bit, reducing the criteria of what and to whom they will lend, and people with less than perfect credit and a less than perfect financial statement will be able to borrow money again. Okay. Other hard money lenders. You can look in the newspaper for hard money ads, call a number of lenders to get a feel for the market in your area. If you sound sophisticated and you talk like you know what you're doing, lenders will be happy to lend to you because sophisticated consumers continually borrow from a lender's available inventory. And boy, guys, if I can stress anything here, get familiar with the vocabulary of this business. Because I got to tell you, I can know within a 20-second conversation with someone whether or not they get it, all right? Just by the words that they're using. Consumers talk in terms of dollars per hour or their salary or what they earn annually. Investors talk in terms of yield. So if an investor friend comes to me, he's like, hey Lee, how's your annualized yield looking this year? Well, what he's asking me is, what's your return on invested dollar going to be? It's a much, much different question than, hey, how much do you make an hour? You see the difference? So get very comfortable with the vocabulary. And I've included a sample script here for you when you're calling out to some of these other hard money lenders. Script simply says, hi, my name is Lee. I'm calling about your ad in the newspaper or Craigslist, whatever it was. It says you have money to lend. How much money do you have to lend? How much of it is available at any given time? What kind of deals are you looking to lend on? What do you charge for points and fees? For how long? What happens if you're not paid back on time? Foreclosure. I haven't identified a property yet, but anticipate picking up 2 in the next couple of weeks and just want to know where to take the deal when I'm ready. Is there anything you need to know about me or the project to lend money on? Now, let me qualify what's going on here in this script, guys. I am not encouraging you to use this script to go in search of people who have money to lend. It's a horrible approach. The reason for using this script is to identify what other consumers of hard money are hearing when they're calling your competition. So if these people are posting ads in the local newspaper or Craigslist, they're your competition. So if you're going to set up a hard money store in your town, you need to know what everybody else is doing. How much are they charging for points? What kind of qualifying criteria and information are they requesting before they will fund? These are the things you need to know. So call them and ask them. And if they've got great rates and terms, then you might even consider using them on future transactions. Okay? Some terms to understand. I'm going to go through and point out the ones you really need to concern yourself with. Obviously, we're all very familiar with points. If you're quoted 5 points, it's 5% of the principal. Remember that points are always front-end loaded, which means they will be paid the minute you agree to take the money on. The minute you sign for that loan, you pay the points. Term is the length of time you have to pay the money back. Okay? So if you're going to lend out money for 90 days, then it's a 90-day term. Understand on that too, if you're going to require monthly payments on the loan, you're always going to amortize the loan for 30 years or 360 months and then put in a 90-day call into the loan. So a 90-day call, 90-day balloon, if you're going to do that. You want to minimize the amount of capital outlay from the person borrowing the money so that they're not spending all of their liquidity on making payments to you and that they still have enough to complete the project. What we typically require in that type of a scenario is that they have 6 months of monthly payments in reserves, or on a 90-day loan they would have to have 3 months of monthly payments in reserve, so we can ensure that they're going to have the necessary liquidity to pay us for our money. Okay? Yield, the annualized rate of return on money lent expressed as a percentage. Fees, the amount that you pay. And understand that in addition to points and fees, you're going to have doc prep fees, you're going to have title fees, you're going to have closing costs. In some instances, you're going to have attorney's fees, excise tax fees, and some other things. So points and interest aren't the end of your fees, all right? You're still going to have other fees associated with the closing. So make sure that you know what those fees are prior to going in. So what you're going to want to ask for from the lending company is a fee breakdown, a commitment letter that shows all of the costs associated with getting that loan. All right. The burn rate, how much money is injected into a company for operations above and beyond revenue. If a company does $200,000 in sales a month, yet they spend $230,000 for operations costs, then the burn rate is $30,000 a month. Now, most of you aren't going to be dealing with burn rate unless you're getting into factoring notes, okay? Factoring is lending on a company's receivables or their balance sheets, and I would not encourage any of you, and I don't really care what level you're at, I would encourage none of you to get involved in factoring type loans. They are incredibly involved. You're going to need to bring in a statistician to determine your risk to reward ratio scenario. And in my opinion, it's just not worth the time, okay? There are companies out there that specialize in factoring loans, and if somebody called me and wanted to pledge cash flow through their business, like we had that question, I would just refer them over to one of those factoring companies. Factoring companies are really quite easy to find. Just Google factoring companies on manufacturing, factoring companies on retail, factoring companies on farming or agriculture. There are all kinds of factoring companies out there. There are even companies out there that will lend on your harvest based on your past 3-year history of what your fields gleaned in that calendar year. So guys, that's really what I love about this business. That's why I think it's so fun. There's literally no end to the types of loans that are available as long as you can present a packaged deal or opportunity that makes sense to everybody that's getting involved. Okay? All right, now call on the back page here. Actually, there's 2 things I want to point out. On page 19, are you guys following along at home? On page 19, we have balloon or bullet, a loan having a payment at the end of the term that is much bigger than the previous ones. Okay, that's a balloon payment. Or a call. And a call is to demand payment or fulfillment of a loan. This is very similar to a balloon payment. However, any conditions can be added for triggering a call. Now what that means is even conventional loans have these, and one trigger that's incredibly obvious, and we're all familiar with it, is if you stop paying your monthly mortgage payments, the mortgage company anytime can say, we're calling your loan due. But as a hard money lender, broker, borrower, you can write in any type of provision you want as to trigger a call. A transference of title can trigger a call, even if it's from an individual to the individual's entity. If you write it into the notes, to the terms of the note, that can trigger a call. And basically what a call is, the way that you implement a call or complete a call is by foreclosing. Okay, a call is a foreclosure. Now, I always get this question when we talk about calls. People say, well, Lee, do you ever have the borrower sign a pre-drafted quitclaim deed or a deed in lieu of foreclosure subject to the provisions that you've created for that call? Which is a lot of words to say, if they don't do this, you can do this. And instead of having to go through the foreclosure process, you can just go down to the local recorder's office and file a deed in lieu of foreclosure, which is effectively a quitclaim deed. So you can reestablish title and regain ownership without going through the lengthy foreclosure process. And the answer is I don't. And I don't encourage that anyone else does either. And the reason why is it's a pre-signed document. And if it's a loan situation where that borrower is under duress, meaning they've got earnest money riding on the line, and if they don't close, they're going to lose that earnest money, they're going to sign whatever you put up in front of them. So if you have them sign a predetermined deed in lieu of foreclosure, and you record it and take back possession without going through the proper foreclosure channels, and they sue you, you're going to lose. Okay? So I don't encourage ever. And guys, if a hard money lender ever asks you to sign a deed in lieu of foreclosure and it's the difference between getting the deal or not getting the deal, you want my opinion? Sign it. It has no legal bearing. Let me qualify that. It has legal bearing. Okay, they can foreclose. They can just record it and take possession of the property. But you've got a ton of rights now as the borrower to now pursue them in litigation because they filed a document that was signed under duress, which is basically taking advantage. And I would never do it. I would encourage that you never do it either. Okay? Now, something else, I want to go back real quick here to page 19 and illustrate this point on the balloon or the bullet. A loan having a payment at the end of the term that is much bigger than the previous ones. You can actually write in balloon payments into the length of the loan however you want. Again, because these are non-owner occupied investment properties, as long as all of the terms of your loan are fully disclosed at the closing table, if the borrower will agree to them, you can charge them. Again, as long as you're within state and local municipality regulations. Okay? What does that mean? Well, let's say that I lend somebody $100,000. And I'm going to do a 90-day loan. But every month after 90 days, instead of paying me my interest, they have to give me $10,000 plus my interest for every month after 90 that they don't pay. Okay? This is an example of a balloon payment, a larger lump sum payment that doesn't necessarily pay off the underlying balance, which is a great fun loan to get because now after 90 days you start getting these lump sum payments in $10,000, then $20,000, then $30,000. Well, this is now liquidity that you now can put back out into the marketplace. So if you're running a private money bank, meaning you're running funds for other people, you've got to really be sure that how you're writing these loans coincide with the amount of volume that you have coming into your private money bank, the amount of funds you have flowing out of your private money bank, so that you're not sitting on a bunch of inventory. Because if you're writing in balloon payments to get cash back, but you've got nowhere to put that cash, why in the world would you do that? Okay? So make sure that you schedule your incoming and your inflow and your outflow in such a manner that you're rarely sitting on cash. You always want your cash working. I've got friends in the business, and you can always tell when they had a whole bunch of money come in that they weren't expecting, early payoffs and those types of things, because I get a call. Hey, Lee, I got an extra $1 million. Do you have anywhere you can put it? Reason they're doing that is they've got monthly costs on that warehouse line, on that money, and they need to get it placed. So they'd rather call me, see if I've got a source to put it in so that they don't have to pay the monthly costs of warehousing that line. Okay? All right. On pages 21, 22, 23, and 24, we've got a bunch of pages here for notes. I hope that you all have been taking notes. And also, guys, before we get into session 2, we're going to take a quick 15-minute break. And on the break, you got to do a couple of things. First thing I want you to do, if you haven't already done this, I want you to print out the manual so that you can take notes on it, as we're going through it. Second thing you're going to need to do, when we go to break, we're going to close this webinar, and you're going to have to go in and opt in for session 2 for that webinar. Now, please write this down. The password for session 2, write it down. It is session 02. Session 02, so that you can go in and access session 2. Now, please write these 2 items down. Number 1, this phone number. It's 800-341-9918, 800-341-9918, or lee@imthesolution.com. If you have any challenges whatsoever in getting into session number 2, make sure you call and talk with Jen, or that you email and talk to Jen, so we can make sure we get you back into session 2. For those of you that are watching this at home, this is going to be the end of disc 1. I want you to go ahead and insert disc 2 into your DVD player, and let's begin with the next session.